So this is the certification course for training for realtors who are underwaterrealestate.com certified experts. Now, if you'd like to become one or you'd like to work with one your home seller, go to underwaterrealestate.com. On the front page, you'll have this video for realtors. You can click through and you can learn more about our program. Right now, in the spring of 2026, it's really, really inexpensive. It's really, I'm going to provide you more value than you actually spend for the certification there. Because there's many ways I can help you if you're a California agent. I'm an attorney and a real estate broker. So this is where we're going to begin. I want everybody who's certified to be on the page with the fact that we put the client's interests ahead of our own, and we understand where the pitfalls are, and we're going to know when to bring in experts, when to explain to home sellers, the things that they need to know about their short sale and loan workout. With the expiration of the Mortgage Debt Forgiveness Act, we could have the odd scenario like we used to have before 2010, where some people financially would be better off taking a foreclosure over a short sale. Now, even back then, in my experience, few of those people actually took the foreclosure over the short sale because many people don't want the foreclosure on their record. Many people know it's not good for their jobs or their career. And finally, there's just a lot of people who can't have a foreclosure because they have security clearances in California and other places. So when we get to the important things, we're going to discuss the difference between recourse and non-recourse loans for California. But for many other states like Florida, where you just have recourse loans, this is really important that you understand. And we'll just get right to the bat. If you're doing a short sale in a state with just recourse loans, your client's going to get a 1099-C from the bank. And let's say it was $1 million property. The bank got paid $900,000. They're likely to see a $100,000 1099-C. Now, will your client, if they understand the process and they're working with their CPAs doing their taxes, will they have to pay all of that 1099-C, all 100,000 in taxes? No, probably not. They should be able to exclude realtor costs and other fees when selling the home. If they really get in the weeds with an attorney, maybe even some of the interest payments can be deducted. And if they really get in the weeds with an attorney, maybe the attorney can help them exclude all of it. But that's a very novel argument. We're not going to get into it here today. I only make it because you can see where the IRS is having a split of logic with respect to what happens after foreclosure. They lost a case in 2023, or it might be dicta, but it's very important. And the logic, the IRS wants to say, you look at the original nature of the loan. Was it recourse or non-recourse? And that determines tax liability. That's not how it works out in training. It's really what happens at the end, after the negotiations. They don't want the negotiations to count. Right now, you should understand, this is an issue with the IRS. Now, for you in California, this is probably why. This is from 625. They made a recent short sale listing addendum. The act expired in 2025. And this is probably why, or one of the reasons why, you'll see here that although the California Association of Realtors discusses the short sale addendum down here, and I've been saying this for years. In fact, when I trained realtors, the California Association of Realtors had me train realtors on how to list, negotiate, and sell short sales. We talked about this. I said, you always want your approval letter to be clear and accurate and mirror the law and the client's desires. You don't want to say, even though I have a law that protects me, I'm still going to agree I still owe money on this loan. Or as California says here, seller as a C.A.R, it says here, is encouraged to obtain a written agreement from lenders or other applicable lien holders addressing whether and to what extent seller will be released from any monetary or other claim, obligation, or liability upon approval of the short sale, and that written agreement reviewed by an attorney, CPA, or appropriate professional of the seller's choosing. Because the Mortgage Debt Forgiveness Act has expired, it covered up a lot of problems. It's like, an upmarket covers up a lot of seller contract mistakes. Well, the Mortgage Debt Forgiveness Act covered up massive potential approval letter mistakes. We don't have that benefit anymore. So the approval letter is going to be vital. Not just, like, they talk about 580E here, and there obviously we talk about non-recourse loans and recourse loans somewhere in here above. We'll get to it. Like the California Association of Realtors, attorneys are quite smart. Yeah, refinance liens, junior liens, we talk about those things. There's tax concerns. Let's just cover it in order, but let me just say, C.A.R knows what they're doing. They're saying you want this addressed in your letter, because when that 1099-C goes out, we know the banks sometimes have amounts that are too large. We know they sometimes check recourse loans even though they're non-recourse. And you're going to want, I mean, now with the Mortgage Debt Forgiveness Act expiring, that $100,000 1099-C, you're going to be, your homeowner is going to need to want to deal with that appropriately. When a lawyer or the IRS or the CPA looks at it and it's no longer a non-recourse loan by terms of the approval letter, you've created a potential for tax liability. Or they, by agreeing to it, have created a potential for tax liability. We want to avoid that. We want to know when it's an issue. We want to know when we need to bring in an attorney. So let's start at the top now. What is a short sale? Now, instead of reading the words, which are very good, we should know that the short sale happens, let's say you owe $100,000 on your loan, and you get a contract. At the end of the contract, you're only going to net $900,000 proceeds for the lender. That's $100,000 short. That is an upside down property or an underwater property. And that 1099-C, that shortfall, normally if you're $100,000 short, the buyer cannot buy that property free and clear. There's a lien against the property, and that lien is there because someone borrowed against the property. The bank's letting the world know we have an encumbrance. It's almost like we have a partial ownership of this property. That's not really the words, but that's the idea. Like, if you want to buy this property free and clear of our interest in the property, you're going to have to clean out this lien against the property. So a buyer comes along, wants to buy the property free and clear so they can get a loan, so they can get full value for it, so they have full enjoyment of the property. They're going to want that lien released. Well, the lien's there to say we have $1 million owed to us. Now, if they're only getting $900,000, the bank doesn't have to clear the lien. They're like, no, we'll clear it for $1 million, not $900,000, unless you agree to our short sale. That, if we agree to be short, if the seller complies with all the terms for our short, then we'll release the lien and that buyer can buy it free and clear. That's what a short sale is. You're short of clearing the lien, so you have to work it out with the bank. And the bank freely clears it out on terms, at least the written terms, the sellers wouldn't be that interested in. And that's where the real negotiating takes place. Because although we have the law, we still want a clean approval letter. And in places with recourse states or in California, you've got recourse loans. What you write in that approval letter could make a huge difference. Now, alternatives to a short sale. This is very important for realtors to know and understand. And I'll tell you why. Just this week, I was working on a deed in lieu for my clients. She lost her job, so she was totally legit hardship. Like, that's one of the cleanest hardships. She was still current, didn't want to harm her credit. We had reasons that I told her. I said, look, we did a lot of deed in lieus back in the original upside down market. But when properties got really upside down, they got clogged up. The banks had no idea what properties were worth. They wanted the system to slow down. They weren't willing to do deed in lieus. I said, in the beginning of this market, where it's easier to understand what the properties are and in a hurry, we could figure out. And it was pretty close. I said, we've got every reason in the world to try to do a deed in lieu while you're current so they won't harm your credit. And I told her, in my experience back then, some banks will just do them. Not common, but we've done it. While clients were current, and it's important that we negotiate for the final letter. And I said, and there's a chance we could get you out free and clear and saying this property is going back in full settlement, no harm to your credit. That's what we would negotiate with the bank while you're current. I said, at the end of it, it's possible they'll say you have to miss one payment. Some investors require that. Some, like FHA and other people, for their insurance to pay off, it must be non-performing. So that's sometimes a requirement. And then sometimes they just won't do it. And I said, and even if they do it, they still might come back and say, they'd rather you do a short sale. And I said, and that's fine. As a realtor broker, I'm an attorney too. I said, and I'm working with you on this short sale, or your local realtor, because she was up in Northern California. We'd co-list the property together, and I'd negotiate it. I'd say, that's fine. I'd make a lot more money. But there might be reasons why you wouldn't want it. She had reasons she didn't want to do a short sale. And I said, but the important thing is the same terms we were negotiating for with the deed in lieu, we'd want to do on the short sale. And in my experience, banks didn't want to do short sales while people were current. Again, this could be an exception, but it's easier to start off with a deed in lieu. So a deed in lieu is, first of all, like we were told, I was told this week that I was on the phone with a representative Chase, very experienced person. He was giving me, I was sort of waiting and talking with him while our customer relation person wasn't talking to us, and he gave me generic stuff, but acting like, it was very informed, but acting like it applied to my file. And I said, well, specifically, are you sure, like, have you pulled up my client's file? Because I want to explain something to you. I said, I'm also very experienced. And I remember back in the beginning of the last short sale market, lenders did do deed in lieus. And I explained in our deed in lieu offer all the reasons why they'd want to do a deed in lieu, rather than force my client into a short sale and have her go 4 months, 6 months late. And I said, and the California foreclosure timeline is now a year long, almost, if you understand everything. And with a little negotiations, it gets to a year. I was like, we should do this now. And he goes, well, tell you what, he actually did something. Like, he got on the phone. He wasn't my person, but he got on the phone. He came back 40 minutes later. He goes, they'll accept the deed in lieu. I was like, I had no idea he was that good. But after talking to me, I think it was kind of a setup. I think you probably should talk to this lawyer, because we had a very strong deed in lieu offer. But he goes, but the other thing is, we got to also, we'll do the deed in lieu, but we got a better deal for your client. We have a forbearance where she's not going to pay nothing. It's not going to harm her credit. And all we need is a small, tiny bit amount, good faith amount per month. And I wrote it down, and I talked to my client, and I told her, and she picked the forbearance. So what is a forbearance? It means generally, it's all negotiable, and it's very similar to loan mod, like from a perspective looking into it. Or forbearance is like, you're not going to pay, probably will not harm your credit, and they'll tack it on the back end. As a realtor, you should understand that when you're doing these things, you need to prepare your client. This happens very, very often. It's already happened to us. We're working with people who are in foreclosure, working on the sale of their property. We had it under contract. Bank called him up and offered him another year and an incredible discount on what they call a loan mod, right? Because he still had a job. He just wasn't making as much. So forbearance is like pretty much no payment tacked on the back end frequently. Loan mod could be change in monthly terms. Occasionally you get a principal reduction. You get changes on the back end. Could be the full amount, maybe a balloon note. I mean, all different terms on a loan mod. But loan mods are like, they're still trying to qualify people. So it's like the same way, like people who've done a lot of mortgages are pretty good at calculating the odds of a loan mod and what the terms might be. At one point I had software and I was really up to speed on that back in the day. But a loan mod would be change in circumstances, can still pay. A forbearance is more likely can't pay for a while, but it might be just temporary. And every bank could be a little different. And if people want to correct me with educated stuff in the comments, if they see this as YouTube or in my course, please do. I after a while, I stopped. Loan mods were a lot of work. I was doing them for $3,000 or $4,000. We got a few. Frequently, they were unacceptable and they turned their short sales. I just told my client, I'll coach you, but you're going to have to do the work. I don't get paid. I stopped trying to get paid for loan mods. Forbearances, like I said, I counsel my client. I said, they're likely to call you up. Sometimes the bank asks me if they can talk to my clients. So I talk about the clients. I tell the clients ahead of time. I know that they're always worried that these guys are pulling a fast one. And if my clients are smart and they're educated and I explain the risks, I say, look, we're more likely to get this done. When they ask for your contact information, I can tell them as a lawyer that I don't want them talking to you. I go, and we can still get, I even brought that up with this guy. I said, hey, it doesn't matter if I let you talk to my clients or me. He goes, no, we like working with you. You're a lawyer. You're in the system from back then. You're not a problem. It's other times we don't really trust what's going on that we want to talk to the sellers. So, your sellers might get their deal done by talking to the bank. And sometimes the banks just call them anyway. So your seller needs to be prepared that the bank's going to call them up. So in ahead of time, they should know what they want to do. Do they want to leave? Do they want to stay? I mean, that's one of the biggest issues. Like, your client should know what they want, and you discuss it. And it's okay for them to be, that's why they're talking to you, to not know in the beginning. But look, when you're going to pick your loan workout option, I think the banks like clarity. And some of the banks are cool. They want to work with you, at least in the beginning. Like, I had a wonderful interaction with everyone at Chase this last on this last particular deal and the previous few deals. Like, I've just started doing this in the last few months, so I don't have tons of experience this time around. But another thing I would tell your realtors is that you want to check all the time, like not just once a week. I mean, like frequently. You're more likely to get your file looked at, and you want to be patient and be the bright spot for these people's day. I can tell, that more honey, you get more things done with honey than vinegar, whatever. This couldn't apply more for banks, even though they're going to lose your documents. They're going to say you should have put your loan number on everyone. Oh, we don't know what you're talking about. I mean, that's just the banks. That's just what they do. And you got to be prepared and check and be nice. And sometimes they work for you and get things done. Maybe they sometimes will work for you and get you better terms for your clients. So that I'm speaking from serious experience there. Nice wins. Nice and organized wins. Nice, organized, consistent wins. Foreclosure. Oddly, because of a 2023 case, it begins with a P, like Peticil. I have it. Where do I have it? I have it at upsidedownrealestate.com in a March 20th blog post. There's an argument, a strong argument, that's the way the case stated it, that even a recourse loan taking a foreclosure, because at the end of that foreclosure, there's no personal liability for the loan, the IRS is treating that as a non-recourse loan. So the 1099-C for $100,000 comes out after the foreclosure. And I would advise my clients, there's a risk that IRS will push this or change their mind, but you're going to say that this is after foreclosure in California. We're going to cite this case. It's a non-recourse debt. You don't owe money on it after foreclosure. After a short sale, we should be able to make the same argument. But if you watch what the IRS is doing, they're trying to break it down. It doesn't logically, legally, it does not make sense. Let me just say it right now. The attorney means says IRS, I will fight the IRS on this for the right clients in the right circumstances, but they're trying to say they look at the original nature of the loan, recourse, non-recourse, and then it doesn't change because you did a short sale or you took a foreclosure. Well, they lost on foreclosure. I think they would eventually, if they get tested, they'll lose on short sale. But you should know the Barbara Boxer letter that I had videos about. It was a great day for home sellers back in the day. 15 months after sending that letter to Barbara Boxer, back in like 14-ish, they said that was overbroad, and they want to go back and look at the recourse versus non-recourse loans in the beginning. They said our letter to Barbara Boxer after 580E was too broad, leaving them open to arguing, which is again why the California Association of Realtors here says what they say about, even though there's this, they come down here and they say sellers encouraged to obtain written agreement from lenders or other applicable lien holders whether and to what extent seller will be released from the monetary or other claim. For me, it's pretty simple. Non-recourse loans, approval letter, mirror the law, we're good. Approval letter doesn't mirror the law, we're taking on risks. Approval letter, ambiguous, we're taking on risks. Approval letter says I still owe on the money. We have a massive risk if the bank then sends the IRS a 1099-C and they check the box that says recourse. Like, that is not what we want. So approval letter, non-recourse loan, important. Approval letter, recourse loan, vital. Like, just to begin your argument, you're going to want to make sure that in most circumstances, that approval letter releases you from the deficiency if you can get it done. Like, that would be the first step to protecting. I'd also examine insolvency. I've done this with clients. You pull out the laws on insolvency and you see if the client fits in. Bankruptcy. Some clients do file bankruptcy. That's one of the ways. For other people, though, who don't want to take foreclosures and are doing short sales, they're going to want to, at the right time in the negotiations, find reasons to dispute the debt or find reasons to change the terms of the approval of the short sale. I'm not saying it's a winner, but I remember there's lots of people who would rather be at risk for financial things than take a foreclosure for lots of reasons, whether because they had security clearances, their jobs, moral reasons, ethical reasons, honor reasons. I had some fine clients that cared about their honor. There are lots of reasons that you'd want to give yourself your best chance and best arguments with respect to the IRS, and would start with a proper approval letter. Now, foreclosure, we kind of cover this. Trustee sales, you're going to want to make sure, if a client is thinking about a foreclosure, that it's a non-judicial foreclosure. Banks, I mean, I worked with 1,000 people. I've talked to attorneys who call me. In my whole career, I probably had a handful of conversations about judicial foreclosures on these kinds of loans. I'm not talking about commercial loans. And I worked with 2, and I know both worked out satisfactorily. And one, I was dealing with people that were a little clueless. And I was like, you realize that if my client answers this and as affirmative defense pleads in the right manner, you're at the mercy of the judge. The judge could seriously, under California law, say my client doesn't owe you money and wipe out your security because of the security first rule. You're at risk. I'm not saying the judge is going to do that, but we have law in California that says you can lose on both with this maneuver. You have to go after the security first in California. Read the law. So lenders almost never, like I said, hundreds of clients for short sales, advised and negotiated hundreds more in foreclosures, walkaway, loan mods. People call me on the phone. Lawyers' conversations, super rare to have a judicial foreclosure. But if you do, you better see an attorney. Non-judicial in California, on one loan can be a good thing with respect to owing on the deficiency or taxes. Definitely want to talk to an attorney about that. Junior liens is a major problem. This is called the sold out junior on a foreclosure. If the first forecloses, there's nothing for the junior to go after, so they're sold out. So, I think it's close to always. If it's a recourse second and the first is gone, they can come after you for the money. They're within the statute and the timelines. And, this is what zombie loans were turning into. So if there's 2 loans, I think unless you really know what you're doing, your client's really up to speed, I think you want to make sure there's an attorney around. Short sales, when you're negotiating with junior liens, I think they get all uppity. Sometimes they're not happy with the deals the first are willing to pay or what they have to take under Fannie Mae or Freddie guidelines or whatever. They're like, no, we're not going to work for that. We're going to hold up this short sale till we get what we want. And we want more. We want money from the client. Realtors, we don't care. They don't care about what 580E says. And the question is, what does your client want to do? I don't think, I remember, at the time I was like, well, my client, the 580E protects my client. If they want to pay some money to get this done, let me go over all this with the client. Let me make sure all the letters are right. Let me talk, I probably talked, to other lawyers, but there's a possibility because the seconds are getting all uppity, but your client can't take a foreclosure. They might be willing to come to the table with a little money, or the realtors might have to pitch in a little bit, even though 580 says it's not supposed to happen. So, banks frequently say things like, we're not controlled by California law. We lent under federal lending guidelines. We're a chartered national bank. We don't care about California law. Well, most of the time you'd expect them to lose in California with that argument, but nevertheless, it's important to negotiate. So it's very important that your client understands banks don't have to agree to the short sale. And so you should be aware of what your client's exposures will be if the short sale doesn't go through, because maybe 50% of realtor short sales actually succeed. What is the downside? What happens after foreclosure? Is your client saving the money so they can reinstate because they don't want a foreclosure? These are things you need to address. These are things we'll talk about in our certified underwaterrealestate.com community in our training. Refinance liens. This is this brings up the hybrid situation. Like, for instance, I had a purchase money loan on the home. I refinanced it to lower the interest rate down below 3%. And my wife and I did. And I wouldn't be surprised if the lender increased the balance at the time a little bit so they could get paid because our rate got really low. So, you might say that we had some cash out on our original purchase money loans. If we took a foreclosure or short sale, would we owe 1099-C income? Well, arguably, you would say that even though we took some money out, it went to the investor, to the mortgage guy. So we still would be fully purchase money loans. But what if we took out $50,000 to buy a boat? Well, that gets more complicated. I'm aware of the law, but I would say you definitely, it gets complicated. So, we're going to discuss that in our training. If you're a homeowner, if you do it right and your approval letter is good, you could succeed and not have too big a problem. But, you could get a 1099-C for some of that income. So it really depends on how you negotiate. Well, we talked about sold out juniors. Other liens can be a problem. Sometimes construction loans get tricky. HOA problems happen. These are things we'll discuss over time in the community. Credit, as I said, right now, a great way to protect your credit would be to start the process, especially deed in lieu, and explain to the bank why, and maybe you'll be able to protect your credit while you're doing a short sale, or you start with a deed in lieu. Your clients, as a realtor, should understand that. It's very unusual that you could do a short sale with the credit, but I don't think it would be impossible in the right circumstances. I don't think you should ever advise your client to stop paying. Go ahead and start it. Now, when the bank comes back and tells you they have to stop paying, you can start negotiating. You say, hey, well, what if we stay current until it's approved, and then we'll go, and you tell us about a month beforehand, and we'll not pay that month. Or if your client wants to protect your credit, you should find ways to help them. Doesn't mean you're going to win, but you could find ways to help them. Taxes, this is significant. We covered it. We'll be there to answer your questions, maybe your clients' questions, at underwaterrealestate.com when you join the community. If you're a client, now if you're a homeowner and you want to work with a professional in your area, go to underwaterrealestate.com, sign up. We'll talk to you. We'll ask you what your concerns are. We'll just like as if you were a client, we'll have you fill out questions about purchase money loans and all that. We'll take a look at it. If it's in California, I can talk to you. If it's not, we'll make sure you get the right people on your team in the other states, whether it's a realtor who knows what they're doing and they understand the taxes. Because as an attorney who understands IRS, I can deal with the taxes and and credit issues sometimes. And I can say, we'll put you in touch with a realtor in the area. They're good. If this comes up, see it and make sure they have an attorney on their team. Like we'll go over those things. We'll make sure you're with, and once they're certified underwater realtor, the handoff's going to be seamless because they're already going to understand all these things because they're certified. Once again, sellers are advised to discuss with a qualified California real estate attorney or other professional choosing before accepting an offer to present to lender or agreeing to any changes requested by the lender already accepted contract. So yes, realtors, banks sometimes have you change the contracts. They're also saying, talk to an attorney before you submit the contracts or accept the contract with the buyer. Because again, you might get stuck. Like what if the buyer's like, if you get approved, it has to go. You don't have any choices. And you're going to want to review these things. Now, one thing I should remind everybody is that lenders sometimes do quality checks. I've gotten calls from other people who do short sales with realtors. They're like, the realtor told me to fudge. It's definitely different. I tried to make myself look strong when I was getting the loan, and then I made myself look weak during the short sale. And I met people with boats and houses who had done short sales. Like, how'd you do it? They're like, we fudged. And I'm like, you realize 1080, 580B, and you realize there's an exception of fraud to all these protections that you have? Yeah, I mean, I didn't scare them ahead of time. My floor just dropped on the floor. I'm like, these people have millions in assets. And to protect their credit, I guess, they lied. And that lie, the banks have quality checks. I've gotten calls from people. The bank compared what they approved the loan for and what they said in their short sale. And they were scared because now they're no longer protected. So you've given the bank a roadmap to your assets, sometimes maybe a significant amount of assets, knowing you were protected by 580B so you weren't afraid, or knowing that if they didn't agree to the terms, you would just take the foreclosure. So it was okay to show your assets. But then you're lying. I was like, this is terrible advice. because all these protections would go away if you read them. Just read the laws. See if really read 580B or 580E or the foreclosure laws that you're going to be using to see if you are comfortable. I mean, I'm not just saying lying is a good policy, but see how bad it is. Now, potential improprieties. Let me just say, this is a very, very, very important thing. And let me just say, a majority of the phone calls I've been getting this year from people in foreclosure, especially when they have a little bit of equity in the home, and obviously a lot of people in foreclosure do have equity in their home. These subject to guys, these guys getting trained by the subject to questionable scammer people. I know that occasionally it could be a legit thing, but what they're doing is they're trying to get into your client's payment scenario, saying we'll come up to speed, giving you a little kicker, and then saying, and we're going to rent the property out. And they're all talking about, well, how do we do this? Well, we get a group home going and we have a lot more assets. Like so many people are saying, well, I've already got stuff lined up in place. I want to get it checked, but we're going to have a group home. And I'm like, well, who's going to be responsible for your loans? Who's going to have deed to your property? What are you doing? Do you realize what happens if they stop paying? What recourse do you have? Can you sue them? How do you stop the foreclosure? Do you have enough money to pay it off then? Are you worried about, there's so much. You're going, as a realtor, you need to understand what these subject guys are saying, straw buyers, house flipping, all that stuff. You need to understand all this because your clients are going to come up against it when they get on those lists. These people don't even realize they're breaking the law. They don't understand the downside. They think they're doing a good job. And like when you talk to them, you're like, well, what happens if you don't pay? What happens to my client? Are they off the loans? Like some of them think that your client isn't responsible for the loans anymore, and the clients don't think that. So they're being told the wrong things. Your clients think that because they set up these structures, they're not the people responsible for their loans anymore, and they almost always are. I mean, why would a bank take a 3% loan and let someone else pay on it and put their name on it when they could be getting 6% for the same money? So almost all these deals are equity skimming, or they're probably illegal if they're in foreclosure, but more importantly for the realtor, I'm not saying be a policeman. I'm just saying I've noticed these are the people I'm up against when clients are asking me for advice or walkaway plans or even doing a few short sales. I'm up against these, in my opinion, most of these guys have no idea what they're doing. They're subject to clowns, probably breaking California law with their offers, not understanding, and if it ever comes up, there can be a few years where a client gets to buy back the property. And they've already sold it. Like, how are they going to not be, criminal at some point? But you should understand. You should take the time to understand that the training on the internet is unreal. If you watch it, it would almost be entertaining. I guess I should be doing. I will do that. I'm going to take them and destroy them for California law. I think that's what we have to do because it's really hurting people. Like you understand, in Florida, some guy had 80 subject to people thinking they were all good and they stopped paying. And then people in Pace Morby's group actually gave these guys the money to give the small amount of money to buy out these sellers and saying you're protected. And they're like, oh, I'm getting money. Okay, cool. And some of the people they interviewed were disingenuous. Like, I was like, oh, you got $10,000. You're insolvent then, you're insolvent now. You were happy with the money. But other people really got screwed. Like there was a dentist who lost tens of thousands of dollars handing it over to some of these clowns. So it's like, maybe Pace Morby does a good job. Maybe it's real for some of his deals, but he was letting people in his membership area getting scammed by these other clowns in Florida. I mean, you just need to be aware you're up against these people. And there's guys doing like almost for sure acting out scenarios where they make the listing realtor look bad and like they're the hero. And I have a feeling these are all setup calls. And they're selling courses too. The mortgage debt. This is very useful. The banks are concerned about this in your negotiations. Homeowners Bill of Rights. You should be aware of it, especially if you're negotiating the short sale. Like, we'll go into the training. Who should negotiate short sales? How busy are you? Are you the type of person that can keep your paperwork together? Do you have good software? All those things. But understand that there are acts that are useful that banks are aware of that can help you buy time and help you get better deals. So good stuff there. A broker's role. You should know a real estate broker cannot give legal or tax advice. in connection with any of the options available to the borrower, nor can the broker suggest what the best course of action is for the owner. And now the people who did this have experience, because they get into the fact that these people there are financial problems and there are family problems. And the most rewarding time of my career as a lawyer and a realtor, when I was helping people who were in such stress, such distress, like the property might have been in great shape. It wasn't really a distressed property. It could sell very quickly. It was the homeowners that were in distress. Right? A distressed property, in my opinion, is a property that's in such a bad state that normal loans, well, you can't get loans on it. Foundations in disrepair, things like that. That was truly a distressed property. I think it's totally misused by the industry now sometimes. I think these are underwater or upside down properties. The clients are in distress, and you can help them. You can say, we can move forward today. This is the worst thing that's happening. This is how we're going to get you out. This is the plan. This is the backup. Now, some people, you should understand, they're not going to list right away. You should probably stay in touch, help them along the way, answer questions, because I found that like 70% of the people that came to my office eventually listed with me or did some other type of loan workout, but they weren't ready that first day. You know, there's a lot of people still want to keep the house. They still want to talk to the bank, maybe see what the terms of their forbearance or loan mod will be, but they come back. Like, you know, you're going to have to balance that. I know you're supposed to close, but I know I wasn't trying to close. I was there coaching and advising and available for more questions. And yes, I know, even I recognize the voice. Some of these national trainers picked me off for some of my best negotiating tactics and how to get leverage on the banks, and made it part of their $1,000, $700 course in training. They called again and tried to get me on the phone. I heard people in the background, and I was like, I knew that this was, okay. So you're going to get calls where they're picking their brain, and maybe they're going to try to work with their neighbor or their cousin. That's true. But the vast majority of people, when they see they know what you're doing and you're there to help, in my experience, they came back. It was very rewarding helping people. Some of my happiest clients. Now, I would also say, well, we'll talk about those other things. There's other things you should be doing when you're doing short sales, so you have a transition. You can transition to a different practice. But I also think this could be going on for a long time, especially with AI. Normal market, you would expect all the people that get transferred, all the people that lose their jobs or other reasons, there should be a percentage of properties that are short sales and foreclosures. For 10 years, because our properties are growing up so fast, people had enough equity to cover their realtor fees within months. So we have had no short sales and foreclosures. I think we're probably likely to go back to a pendulum, and I think it's going to swing high. I don't think it's going to be as deep as it was last time, but I think it could last for 10 or 20 years with AI replacing all these jobs. And it looks like it's good. Like if you're talking to people in the Bay Area who've just lost 8,000 jobs with Oracle, the tech jobs, some people in the Bay Area, the tech jobs are like, it's bad. And that's like, I remember being in San Diego when Rancho Santa Fe fell apart. It was so bad. You didn't even want to go. We had friends who lived there. You wouldn't even want to go to their barbecues and their parties. They were so depressed. They thought it was the end of the world. Whereas just a few towns over, like Carlsbad was already recovering. They were just a year or two behind. So they thought it was the end of the world. It went in slower, but they were still miserable for a year or two when people had already recovered just nearby. So, it's very local. Real estate's local, right? That's why we have a course. Broker authority. Now, there's just one thing in here. There are times a home seller will cooperate with the bank, but they're going to keep asking for more and more information. I would not say, oh, we've got a listing agreement. You have to produce this information. You've signed this thing. Your seller in the end should know you're on their team. And if they don't want to produce to the bank, you're going to have to find other ways to get leverage over the bank. And sometimes telling the bank no, you'll still get the deal done. My name is John McConnin. Underwaterrealestate.com. If you're a homeowner, is where you're going to work with a team. And we're going to start with your real estate agents. They're going to be certified licensed. They're going to understand all this. They're not going to be lawyers when they're not supposed to be, but they're aware of it. They can coach you. When you need a lawyer, especially like reviewing approval letters, they'll have lawyers on their team you can work with. We put your interests ahead. If you've got low equity and you want to avoid a short sale, let's say you're underwater because after you pay $50,000 in realtor fees and closing costs, you're underwater. Well, our realtors are going to try, like, if they can cut their fees in half and avoid a short sale, they're going to do that most of the time. Like, we're going to talk to them about that because they want you to avoid a short sale if you can. The buyer gets to buy the property sooner. You get to move on with your life sooner. You won't have some of the marks, the credit problems or other things, like if you have recourse loans that a short sale might involve. So we're going to work with low equity home sellers. Like, that's where we start. If your property is worth less than 10% more than the loans, you want to talk to a realtor who understands all your options. And we'll start you off at underwaterrealestate.com with the right people and the right teams. Now, if you're a realtor and you'd like to work with us, become a certified underwater real estate expert. You're going to have the community. We're all going to work together and make ourselves the best community. But I will lead it in the beginning for sure, because I have to, because it's new. And I will answer questions. We'll have part of the certification training. I will get into how I went. Like, I have a video at underwaterrealestate.com where within a few years, I show just in San Diego alone, I did 60 short sales. And you can see that in the Wayback Machine. And we did short sales in Riverside, Orange County, LA, Northern California. I actually had an office up in the Sacramento area. And I'm going to talk to you about, there are ways there. And when you're content marketing, what works for clients and allows them to know you're the person, and what terms, what's the really important content marketing strategies and even paid marketing strategies that work. We're going to be discussing that inside our community and our training, because once you're certified, we believe that if people are doing short sales, they should be doing it with our clients who are well trained and have their sellers' interests first. So underwaterrealestate.com, and if you're a realtor, click through, go to the realtor page, and considering our certification, and I look forward to working with you. And I can tell you right now, no matter what you think I would be charging for the certification, it's probably less right now. Like, I'm not willing, while this course is new, I'm not going to charge much. Once it's all fleshed out and we've taken a few cohorts through, we're going to get to that $700 level that some of the competitors are at. But right now, it's a lot lower than that. John McConnin, real estate attorney and a broker. The California Association of Realtors had me train realtors how to list and negotiate short sales. And I want to make sure that everyone selling their home and everyone helping them sell their home understands that the client's interests are first. And we also understand how to do a great job for them. Thanks. Talk to you later. Bye.